Jason Kosec, President and CEO of Integra Resources. Integra Resources is a leading growth-focused precious metals company focused on the Great Basin. That company currently has a resource endowment just over 10 million ounces and a combined net asset value of 1.2 billion, and is now producing from our Florida Canyon asset of about 70,000 ounces per annum.
Jason, good to see you. Welcome to London.
Thank you for having me.
And thanks for making it this way. You've been on a bit of a tour.
Yeah, I think this is week 4.
Excellent.
So it's
Excellent.
been really
So much fun.
It's been a lot of fun. The story's been very well received after the recent acquisition of Florida Canyon. So happy to be here.
Congrats on that. What's the kind of the feedback been so far? Let's start with that.
I think people are overwhelmingly very supportive.
Right.
For a number of reasons. One, the actual purchase price, and 2, this is really now a self-funding vehicle. Okay, the building blocks are frankly in place to go from 70 to 250,000 ounces per annum over the coming years, and really most of it being funded out of cash flow. So very, separating us from the developer peer space that always has to constantly go to the market, raise money. We don't envision doing that. And really, you're going to be tripling production over the coming years.
Right, there's a few things you got to do to be able to achieve that, and we'll get into this. Just mining's easy, right?
Yeah.
Yeah. Let's start with the acquisition. I think people felt you needed to do something like that, but you've actually ended up with not a bad asset. It's kind of pretty interesting in terms of the portfolio mix now.
Yeah. So the beauty about this asset is it's 40 minutes from our Nevada North projects, 2.5, 3 hours from our Delamar project. So it creates this regional mining platform and allows our team to control our consumable costs. It enhances our social license to operate within that area and secures a local workforce in a very competitive working environment, right? Which is really, really, really important.
Right. The kind of cross-border thing, is it kind of irrelevant? Does it add any complexity?
Well, from your service providers, so the guys that provide your cyanide, your lime, your ammonium nitrate, truck tires, maintenance contracts, you're all going to the same provider. I can give you an example of about for cyanide, for our Delamar, for the feasibility that was upcoming, they were quoting us $1.45 a pound. Florida Canyon's getting cyanide delivered at $1.09 a pound. We went back to them and said, okay, fine, we'll do it for $1.15 a pound. So the synergies are real when you create this regional platform.
Right. Okay. And let's talk about the acquisition itself. You say you picked it up for what? Talk money to me.
It was 68 million in shares. I'll talk all in US dollars.
Yeah.
So it's 68 million. This year alone, Argonaut sunk $43 million in building the pad expansion, pad 3A, and building the CIC. Mm-hmm. Not only that, it came with $24 million in cash and no debt.
Okay.
Yeah.
Did anyone appreciate that? That's right.
Yeah, I think...
Didn't pop out of the presentation.
It didn't, because we couldn't really disclose it until we just reported our financials, right?
Nice.
So it's, the team there has done a really good job. It was a big turnaround story in 2023 when they brought in the new GM.
Yeah.
And, hit record production, record free cash flow. So it popped up on our radar in 23.
Yeah.
We approached them. It wasn't for sale at that time, as they believed they'd just turned a corner. And then obviously Alamos went after Argonaut for the Magino asset, and here lies the opportunity.
Right. So not non-core for them, but for you guys, it represents a lot of synergy and obviously changes the growth profile completely. Let's talk about the what it does today. So 71,000 production last year, 2023. 7-year life of mine. Is 70,000, 71,000, is that sustainable?
Yeah, so listen, it's very steady state, 70 to 75,000 ounces over the next 7 years, right? For the next year, we don't envision anything materially changing from the technical report that was published in July of this year. There's a number of optimization studies that both the Florida Canyon team recognized, a few more that we recognize that will be kind of executing on in 25 to potentially lower the cost profile and increase the mine life.
Right.
We saw, a number of exploration targets, more on a regional scale, but some in the Florida Canyon mine footprint proper. So, we think there's significant chance to grow the resource base.
Right. You're looking at ASIC of 1550.
Yeah, well,
Does that change?
It like any mine, it varies. Okay, so over the life of mine, the 7 years, the average is 1525. There are higher cost years. There are substantially lower cost years than that, but it balances out about 1525.
Right, and just to make sure, because I think all three mines have a very sort of similar grade profile, right? But in terms of the ore body itself, a lot of oxides, which you're dealing with at the moment with the heap leach and so forth. How long does that continue for?
Yeah, so I'm only talking about oxides.
Yeah.
Our model is keep it simple, stupid. So
You do have some non-oxides, which I thought was
no. We half the resource of the 10 is sulfides. Yeah.
Right.
But you're looking at 4.7 total of leachable material. The beauty about this is, Delamar and Nevada North are slightly higher grade and slightly lower strip, so the margins are better. But it's the same throughput, same mining method, same deposit type, same processing method. So it's
same skill sets.
Same skill sets.
Okay.
It's wash, rinse, repeat. So where you have the potential for a problem building heap leach projects is usually in your pad. In your recovery models. And the beauty is that the Florida Canyon team just did a pad this year. They'll do another one next year. And then in 27, they'll do the last one. That will give you, a little bit of wiggle room at the end.
Okay.
And then they go to Delamar to do that pad. Then they go to Nevada North to do that pad.
Yeah.
So you have a team that, has done building heap leach pads, multiple times in the same environment, which will substantially move a lot of risk when you go to build our other two projects.
So like super cookie cutter. I know they're all kind of close proximity, but presumably the pads are set up in each of the projects, right?
Yeah.
That's how that thing works.
Yeah, you can't when you're looking
not
at
trucking anything.
When you're looking at 0.5, you can't truck it more than 5 kilometers, right?
Yeah.
The one thing that you could do to offset costs is truck the loaded carbon. So it saves you, call it $7 million on your AID plant, right? That's the only thing you can do. But the beauty is that as Florida dwindles down into these smaller pits, that's if we extend the mine life. We're running 777s and 992 loaders, so those can go literally 40 minutes across the highway, in turn dropping the initial capex for our Nevada North project.
Okay.
Right, the team would move over there as well.
Right.
So again, a lot of operational synergies that this asset really unlocks, and frankly, it's really the matchstick that unlocks, the $1 billion of mining nav at $2,000 gold for Delamar and Nevada North. The reason why developers trade at 0.1, 0.2 is because everyone knows you're coming to the market for $10 to $15 million a year. That's the real cost to bump these projects along. So removing that removes that financing overhang and allows us to have a re-rate opportunity in line with our peer set, which is call it 0.4 to 0.6 for companies of our nature. I'm not going to say that we'll be like a G-Min or an Orla right out of the gate.
Yeah.
They've done a spectacular job, or even a Caliber. But I think in the longer term, you could see that as our cost profile comes down and our production profile increases.
Right. And when you're looking at these sort of savings across the three assets, obviously you talked about some of the chemical examples there. What about the other kind of operational infrastructure type stuff? Well, like say trucks, diggers, etc., like that. That presumably they didn't own those.
No, we do. We own
you own them 100%?
We own the fleet. Yeah,
okay, so it's just a simple maintenance.
Yeah,
okay,
so,
interesting.
The engines and usually the box, the shovel, you got to do your rebuilds depends, on a lot of factors, but usually out of an engine, you can get around 16 to 30,000 hours.
Okay.
Off before you rebuild it.
Okay.
And you usually can get 10 to 20 years out of your fleet if you're maintaining it and make sure your haul roads are in good nick.
Yeah.
controlling your dust, all that sort of stuff, preventative maintenance.
Okay, so now you can. It's interesting. So let's talk about the kind of sequencing here, because you've got feasibility coming up on Delamar, in production over here. Got a PEA, Nevada North. It's kind of like it's a little jigsaw which you need to kind of fit together to kind of hit this 250 number, which maybe we can go for. So how do you sequence that in terms of allocation of cash, allocation of time, effort, etc.? What takes a slight backseat, or can they all move forward? And you got permitting in there as well, so it's all...
what great companies have done in the past, and frankly, any business in the world, it's disciplined capital allocation, right? So there's a big focus on 25 to optimize Florida Canyon, extend the mine life, because that's the most accretive.
It's making money today.
Exactly.
Can it make more?
When you look at it, it's like, the exploration potential at Nevada North is significant, as we talked about in the past. But, when it's a 13-year mine life, adding year 14, 15 and discounting those ounces back is not giving you any value.
Yep.
But extending Florida by 2 years is instantly NAV accretive, and dropping the cost profile is instantly accretive. So there's a big focus on operational excellence at Florida.
Yeah.
Okay. And then those studies, all the drilling that we're doing from geotech, infill, some short range variability, some met holes, some condemnation holes. All that's ongoing next year, and we'll put out an updated technical report for Florida in the beginning of 26, and then show 3-year guidance with those optimization studies.
Yeah.
There is then obviously a big component to Delamar, okay, as it will most likely come on next. So, they're finishing the feasibility. That'll come out end of Q1, early Q2. That'll include the stockpiles that we discussed prior to, which are, really high margin ounces, because it's a free dig, so you save about 30 cents a ton. Adds 42 million tons, so extends the mine life probably about 3 years, and keeps the production profile between 135 and 140 over the 10. So that's very accretive. In conjunction with that, we also have permitting for Delamar. Yeah. So we're updating the mine plan of operations with kind of the new designs in the feasibility, because there's been a few tweaks, as you can imagine, from your PFS. So that's ongoing. The idea is to have your notice of intent signed by the end of 25, which under the new regulations that came in July, that's really puts you on the 2-year shot clock. And we have Butch Otter, who's on our board, who's a governor of Idaho for 12 years, so he helps navigate the political landscape, and he's red as red can be, so he has good connections into both the state level and the federal level to help us along that process. And then you still have Nevada North, so there's some long lead items that need to happen for submitting the mine plan of operations for Nevada North, primarily being the humidity cell testing for your geochemistry.
Okay.
Water is secured there. So as the studies at Delamar, the spend goes down in 26, you'll have an increase at Nevada North to run them in parallel.
Okay. So that flow works. Okay, let's go back to Florida. You when you say about efficient allocation of capital, what does that look like? Because right at the outset you said this is now self-funding, right? This is not a dilutory investment platform for investors anymore. This is something which you're going to run as a non-dilutory way, right? So allocation of capital in dollar terms or meter terms on the exploration side to kind of extend this life of mine. What does that look like?
Yeah, so for all the optimization stuff in the infill drilling, the budget for Florida Canyon is around $3.5 million.
Okay.
Yeah, that really helps, and like I said earlier, we don't envision going back to the market, and if people want to look at the production profile and cost profile, the tech report was published in July. We don't see it materially changing, so plus minus 10% for 25. We will be putting out formal guidance pre-BMO, so end January, February. So until that happens, I will refer people to the technical report.
Okay. So that gives us a sense of what goes on. But needless to say, your idea is, bare minimum, maintain production.
Correct.
Idea to improve and grow production.
Yeah, there's
okay.
there's a number of things. In 25 and 26, the strip ratio is at 1.2, 1.2, and then it drops to 0.6. So what we're looking at is the overall slope angle is quite conservative at 35. To put that into perspective, Delamar, Nevada North, you're running it at around 45, 50.
Yeah.
So the steeper the wall, the less waste you have to move. So that has an impact. So looking at that, looking at doing condemnation holes to run a short haul to increase your cycle time, increasing your mining rate, looking at double benching, size recovery models to see if we can increase the powder factor in the fragmentation in the pit, because the cheapest way to crush your rock is to blast it. So there's a number of things.
Yes. Okay. You're going to look to reduce the costs. You're going to look to
Extend the mine life.
but not necessarily the production. Is that what we're hearing?
It's too early to say.
Right.
Again, we'll let it. We need to
close this in November, I guess.
Yeah, we closed literally 2.5 weeks ago. So we've been pushing hard. The team's been working really well together. But there's a number of things that we have to do. There is the potential to push some ounces forward. But again, you need to do all the work in the studies, and I don't want to be saying this thing is going over 100,000 ounces.
Yeah,
I rather be very conservative from that approach until we finish doing all the work. But the tech report is quite robust and really outlines quite a solid plan.
I think like every conversation you've had for the last 3 weeks, people are going, well, how do you take advantage of this high-priced gold environment? Right? I think that's a little bit of excitement or frisson for producers who are getting rewarded, by the way. I mean, once people start recognizing what you've got and what it costs you, do you feel that you're going to be able to get that track? Because there kind of needs to be that step change. There was initial excitement, and they kind of dropped off again.
Yeah, you had the initial excitement, the share price ran, then gold pulls back almost $200. Everything pulls back. I think it's got a little overbought. Now it's a little oversold.
Is it about right now?
Yeah, I think what you really got to do is you've got to put out a good Q4. That's the first quarter that we'll report on, and they'll show consistency and predictability through 25. And with that, I think in a solid feasibility, the market will really give us value for that. And the biggest thing that share price appreciation will do will also allow us to get into some of the major indices like the GDXJ and the Russell 3000. So we'll make, right now we check the box for all of that except for dollar value volume. So as you see that share price appreciation and we work on our marketing campaign, I think, getting index inclusion, qualifying for it by the end of the year and next year will be a huge value driver.
Yeah, and you obviously think, well, what we're seeing is companies getting rewarded are producers at the moment and advanced stage developers. You got a little bit of both going on in there. You can't get away though from the kind of Utah factor for some. In this
Idaho.
Sorry, good. You can't get away from the Idaho factor for some, in the sense that they feel like the permitting side of things is a little bit harder, a little bit elongated, etc.
Yeah, obviously we know why that is for one company.
Yeah,
and
it rubs off, right?
No,
in terms of thinking.
It does, but it's project dependent, right? Yeah. This is a restart of a brownfield site. There's no major waterways. There's no Forest Service. There's no fish. People aren't fly fishing or going backcountry skiing. It's been a mining town since the 1800s, 1860, or when Joseph Delamar founded it. So when you look at the impacts that, ICL, Idaho Conservation League, flags for any projects in Idaho. The one that's taken too long has all 5 things that they want to be concerned about.
Yeah.
We have one. So, and it always comes down to water. And so having basically catching all the water, putting it in a water treatment plant, then discharging allows us to remove that one pain point, so to speak.
Right. And how long is that going to take, that process? Because in terms of like getting this kind of blend of revenues coming through, obviously you're just working through the fees at the moment, right? But it's fairly advanced, right? Q1 or 2 next year. At that point, you want to demonstrate to the market you're close to getting into, feed and FID and all of it, getting your financing in place for this. Does that pain point, as you describe it, fit into that schedule, that timeline?
Yeah, like I said, like we'll have the notice done by the end of the year.
Okay.
And that's
25.
25.
Right. Okay.
So then end of 27.
Yeah.
Ideally, you would have your record of decision. Mm-hmm. And at that point, you would do your project financing because there's some ancillary state permits that have to coincide with your record of decision. And, again, depending on when you get your rod, you don't want to start construction in the middle of the winter.
Yeah.
So, call it's a 12 to 18 month build, depending on when all the permits come in. Because you don't want to start in the winter.
Right. Okay. So it's a big part of the story really is
so
really,
that would get you over 200,000 ounces.
No, I hear you. It combines.
Correct.
Right, yeah. No, I hear it. It's exciting going forward, but so therefore it really does kind of put that onus back on Florida, and we'll wait till February so you can give some guidance. But I think it'd be intriguing to sort of see what you're going to be able to do that the previous guys weren't doing or hadn't got around to yet. Is that a better way of putting it?
Yeah, it's happened multiple times, right? You can look at Wharf when it was a non-core asset, or when Caliber bought the B2 assets when they were non-core. When you have the ability for that to be your sole focus, it allows us to give not only financial allocation but intellectual allocation, to look at all these little dials that we can turn. And it's not one silver bullet. It's 3 here, 7 here, 10 here, 2 here, that all added up can be material, right? And when it's a sole focus, it allows us to do that.
So we're in engineering mode, but not forgetting giving us a bit of blue sky with the exploration. Is there known data outside of the current plant in terms of around the exploration?
Yeah, listen, there's a fully permitted mine called the Standard Mine about 5 kilometers to the south. It's got about 180,000 ounces. There's a lot of ancillary little targets that have been drilled that need a lot of follow-up. There hasn't been a drill hole south of the project or north. There's been like 5 in the last 20 years. So, can we add another 3 to 5 outside the current mining footprint? I think so, but it's not gonna happen in 26. It'll happen in the coming years.
Well, it doesn't need to, but I think people need to understand, the cost and the timeline for that to come into the M&I category and how that kind of feeds into the existing operating process.
You're looking at, like, to do all that, you're looking at $3 million a year to drill and to
these are cheap ounces.
To do the kind of the study work needed to pull those into a mine plan.
Okay. February. I'll wait. With the PEA, obviously on the Nevada North, or North Nevada, which way around is it?
Nevada North.
Nevada North. Obviously a little bit further behind the curve there, but again, that's kind of will come through eventually. Are you going to be spending much time and effort there in the first couple of years?
So, like I mentioned, as Delamar, goes into the NEPA process and the burn comes down, then there'll be a focus to go to Nevada North. And, even though it's a PEA, you got to remember that 80% of the ounces are measured and indicated, and the conversion rate is around 87 to 90%. So it is not your typical PEA. The other thing too is that because it sits above the water table, it stays below the 640 acres of total disturbance because the strip's about 0.25. So no waste rock really. You can most likely permit it under an EA, which in Nevada is 6 months.
Okay.
So it's
Okay,
a quicker,
so
quicker,
it's a quicker process.
Yeah.
Which I guess maybe negates the next question, which was around, right, we've done some M&A here. Usually gets rewarded. Sometimes, despite the asset, it gets rewarded. Are there other assets in the district that you're sort of looking at, conversations that you're having, and you think, do you know what I mean? Because it's a kind of quick way to kind of get you noticed by ETFs in terms of size, and you may be able to then obviously engineer it physically or financially to kind of fit in.
Yeah, like since we built Millennial and even with Integra, we've done a deal every single year.
Right.
That being said, or a divestment, acquisition, or merger. That being said, we need a better currency to do something now. So like I said, big focus, operational excellence, get the fees, get the NOI. Most likely get rewarded on the back of those major milestones. But we've looked to date at over 357 projects, done over 72 site visits. We always look, but again, it has to be strategic and accretive. And right now, it's focusing on what we have in the portfolio. Because the building blocks are in place to basically push this thing well over 250,000 ounces per annum.
Right. Okay. All I'm trying to get a gauge of is the aggression and the ambition here. Okay, 250 sounds great. At some point in the distance, more is more, always, right?
Yes. Listen, we always look, and the idea would be yes, if something accretive that fits into our portfolio comes along, we will definitely look at it. But I again, we need to be cognizant on where we're trading right now at 0.22 on a P/NAV basis. If we're trading at 0.5, 0.6, well, okay, yeah. Well,
but you got to know the production profile, which you can now say I'm a producer, right? That changes the conversation.
Totally.
It opens the doors a little bit, and maybe even changes the cost of money for you. Clearly.
Totally.
So if anything, this puts you in a strong position to have those conversations. Now you've got this out of the way. A few things to do. Well, your team's got a lot to do. Okay. Well, I guess I'm waiting for February then.
Yeah.
I'm excited for you guys, and well done for getting this thing over the line, and now just get into the weeds.
Yeah, big thanks to the whole team. They've done an amazing job, and we run hard. They've done a fantastic job.
Good man. Good
Thanks
to see
a
you.
lot.
Thanks very much. Cheers.